Hey everyone, so a couple of days ago I posted a video about the yield curve and the bond markets, and in that video I briefly spoke about how Warren Buffett actually views stock market intrinsic valuation in a very similar way to bond valuation. And this was something I actually first heard about 5 years ago when watching through some Berkshire Hathaway annual meetings. And in the video, as I said, Buffett talks about bond valuation, and it really opened my eyes to how I should be thinking about figuring out what price to pay for a stock, and it actually makes it a lot easier to understand valuation once you've gone through the practice of learning how to value something simple like a bond. So that's what we're going to do in today's video. I'm not going to only just show you how to value a bond, but how it exactly relates to the valuation of stocks. Just before we get into today's video, I am pleased to announce that the Learn by Example platform and community is now open for April enrollment. If, like me, you consider yourself a Warren Buffett or Charlie Munger style value investor, and you've been investing in the markets a little bit, maybe you've watched a bunch of my content, but you're ready to take your analysis to the next level, then you may want to consider joining our private community. You'll be joining a private community of 300 value investors, as well as getting access to my platform where there is a ton of exclusive content, including over 80 hours of real example stock analysis, reports and presentations that I've done on real companies to demonstrate how I'm analyzing real companies so that you can apply that process to other businesses that you're looking to analyze and maybe invest in. There's also a 4-hour crash course on valuation specifically. So if valuation is something that you found really challenging, which is the case for a lot of people, then this is exactly what you need. It will take you step by step through exactly how you should be thinking about valuation, getting yourself in the right mindset of what we're trying to do, and also exactly how to calculate it for businesses, including projecting reasonable growth rates going forward. Also, every single week we do a Q&A live stream where I answer every single question, and the live streams are recorded, and you can use the searchable library of about 75 hours of past Q&A sessions to look through, search through, and find answers to questions that I've answered from students over the past 3 years while I've been running this community. Most of the time the community is full, which is why I don't promote it or talk about it on the channel, but at the moment, I think at the time of recording this, there's about 30 spots available, and you can get 30% off if you want to join. So use the links down below. All of the information you need is down there. You can contact me via email if you have any questions before you join. Warren Buffett's trick to figuring out what a stock is worth is to start by figuring out what a bond is worth, which is something we can get a little bit more exact with, and then applying those same core principles, the same structure to the stock market. And I know bonds sound boring, and they are boring, but if you want to get better at investing, this is your ticket to it. A bond, like any other cash producing asset, is valued based on the cash that it produces in the future. So what cash is it going to deliver to the investor, and then discounting that cash flow at an appropriate rate. And the simple thing about a bond is it's a fixed income instrument, right? It pays a fixed amount of cash flow to the bond holder or to the investor. So it means that we can get very accurate on what the value of that bond is. A bond has 4 key elements. Face value, which is the amount of cash paid by the issuer at the end of maturity. So it's kind of a lump sum that you get for the bond. Maturity tells us when the bond ends, and at that point, the face value would be, of course, paid to the holder. The coupon rate dictates how much cash is paid out as interest each year, and the yield to maturity is the return that will be earned by the holder if the bond is held to maturity. And these 4 elements make up the formula of a bond. And this formula can then be rearranged depending on what you're trying to solve for. So you might have the face value, the maturity, the coupon rate, and the price of the bond, and you want to figure out what is the yield to maturity. What return would you get if you bought that bond in the market? Or what we're going to be doing today is we're not going to have the price of the bond. We're going to have the face value, the maturity, the coupon rate. We're going to insert a yield to maturity based on what return we want to make to figure out the last element, which is what price we should pay for the bond. So let's quickly go through a simple example. Let's imagine a bond with a face value of $1,000. It has a maturity of 5 years, a 3% coupon rate per year. So on a face value of 1,000, that means it's going to be paying $30 out in cash flow every year. and the yield to maturity we're going to set at 5%. Now, you might be wondering, why 5%? Where did that number just come from? Well, the reason why we're saying 5% in this example is because let's imagine that when we're looking at other types of bonds that are of similar quality, so let's say these are all AAA, really high quality bonds, actual real high quality bonds, not like the ones rated in the GFC, but let's say they're all high quality, and other bonds that we're looking at are offering us a 5% return, a 5% yield to maturity. So that's why we would use a 5% yield to maturity in this calculation, because we're using it as a yardstick, as a benchmark of what return we would want to make on this bond, because it's a similar one to these other bonds where we could also get 5%. Another way to think about it is when we stick the 5% into the formula, it's essentially telling us what price would be the maximum we would be willing to pay for that bond, because if we paid more for that bond, we would earn less than a 5% return. And why would we do that with this bond if we have these other bonds that are available to us at a 5% return? We would just not invest in that bond and buy this one instead. So we enter these elements into the formula like this, and the answer that comes out is $913.41. So what this means is if we paid $913.41 for this $1,000 face value bond with a 3% coupon that lasts for 5 years, and we held it to maturity, we would earn 5% per year. So hopefully that example helped to demonstrate how when we think of valuing a bond, and frankly valuing any other cash producing asset, we're really just looking for a mathematical way to represent two real key things. Well, three things really. One is, what are the cash flows that the asset will be producing for us? When will we get those cash flows? So in the case of a bond, it's kind of evenly spread out, and then a face value at the end, a big lump sum. And also what return we want to make. Combining those elements to figure out what we need to pay in order to then receive those cash flows and earn the return that we're targeting. And Warren Buffett sees business valuations the exact same as a bond, except that instead of looking at a 5% bond with a face value coming at the end of that period, we think of a stock as a 100-year bond. A stock is exactly the same as a bond, except that we don't know what the cash flows are going to be, and there's no 5-year maturity. The business just continues to produce cash flow each year until it doesn't anymore, until the business no longer exists. So we can approach valuation in the same way, except we just have to do a little bit more work. Instead of just sticking in the coupon rate into the formula, because the bond just tells us what is the cash flow that you receive, we have to estimate what cash flow the business will produce in the future, because like a lot of businesses that have great competitive advantages and great management teams, their cash flows in the future might be significantly higher than they are today. So we need to make a projection about what the cash flows will look like over the next few years. Now, that bit where Warren Buffett says we think of it as a 100-year bond, that might seem kind of daunting. Like, do we really have to calculate cash flows going out into 100 years? I don't even know what the world's going to look like in 20 years, let alone 100 years, right? So no, we don't need to do that. That's really more of a theoretical way to think about a stock. A stock is essentially a bond that goes forever until it dies. But what we do is we use a discounted cash flow, which is a mathematical formula that looks very, very similar to how we do bond valuation, except instead of getting a face value at the end of, say, 5 or 10 years, we use a terminal value, which reflects the value of cash flows produced after that year into infinity. Now, I'm not going to explain terminal value in this video. This video will go on forever. I'll leave a link to the specific terminal value video that I did down in the description below. But all you need to really understand is what we're going to be doing is projecting forward 5 years of cash flow or 10 years of cash flow, then adding a terminal value, which reflects all of the cash flows after that time. And combined, that gives us a value of the cash flows discounted back at an appropriate rate, which is in this case, the target return we want to make on the stock. The best and easiest way to do this is by using my free spreadsheet resource, again, linked down in the description below. You can download it and use it on Google Sheets, and it will basically do all of the maths for you. So you just need to have the inputs available to you, which doesn't necessarily mean it's an easy job. We're still going through the difficult process of projecting cash flows for a business in a messy economy, but it does make it easier in that we don't have to manually do all of the mathematics. So in my spreadsheet, you head over to the valuation sheet and you'll see this massive, or a couple of tables here. Don't worry, I know there's a lot of numbers on the screen, but you only have to worry about the white cells. That's where you have to fill it in. The grayed out cells, you just leave. So you can see that there's a couple of things we need to enter in. First of all, there's 5 different models because I like to calculate a range of intrinsic value because we can't get to an exact number. So it's a good idea to come up with a range of values in which intrinsic value likely sits. And for each of those models, we need a starting cash flow. So whatever is the profit figure for the business from the past year or an average over the past 5 years. I use a figure called cash flow for owners. I have a video talking about it specifically on my channel if you want to check it out. And then we need to project a growth rate. So I've got a range for this example of between 4% per year and 12% per year. I then need to enter in the required rate of return. This is essentially the yield to maturity of a bond valuation. So this is our target return, what return we want to make. For me, this is going to be 15%. We need a terminal growth rate. This is the rate at which profits will grow at per year beyond the 10th year into perpetuity, into infinity. Usually you want to keep this pretty low. I would usually just leave this at 0. We then need a margin of safety when we're doing business valuation. We don't need this if we're looking at high quality bonds because the cash flows are almost certain. However, in the business world, the future cash flows are not certain. And there's things that can happen that can influence the profits the business produces. So we want a margin of safety for errors in our valuation and for the randomness that is the stock market and the economy. And then the other thing that we take into account is the cash and the debts that the business has. This doesn't have anything to do with bond valuation because when you're buying a bond, you're not getting a piece of a business that has assets and liabilities. But when we're investing in stocks, they do have some cash on the balance sheet sometimes. They do have some debts, so we want to consider those in our valuation as well. And once we've entered in all of those things, the spreadsheet will calculate a fair value for the business. So that's the intrinsic value based on what return we're targeting. It will calculate that on a per share basis, and then it will give us our buy price, which is simply the fair value taking into account the margin of safety, which in this case is 50%. Now, I won't be able to go into the details of how we project reasonable cash flow growth rates into the future and figuring out what is a good terminal growth rate. I'm not going to be able to do those things in this video or else it will go on forever. So there's a couple of options available for you if you want to keep going here and continue to learn. One is you can check out the 4-step stock analysis YouTube playlist that I'll link down in the description below. That playlist has about 15 free videos available to you, and it has a couple of videos on intrinsic valuation specifically. It will take you through terminal value and how to calculate growth rates and that sort of thing. So check out those videos if you haven't already. If you've already gone through those videos and you want to go deeper, then consider joining Learn by Example. You'll get to join our private community. You'll get access to the intrinsic value crash course specifically on valuation, and you'll have access to me to answer those difficult questions on an ongoing basis. You can get 30% off at the moment if you join. As I mentioned, there's only a couple of spots available, so go check it out. Everything you need to know. There's a lot of links in this video, but everything you need to know is linked down in the description below. So with that said, I hope you guys got some value out of today's video. If you did, make sure you leave a like on it. But with that said, I hope you guys have a great day, and I'll see you in the next video.